And the next speaker I have been looking forward personally to a lot. Because, ladies and gentlemen, if there is one person who can embody the future of European media, it's our next speaker. He's got the wisdom, he's got the insights, he talks really fast. So please buckle up and enjoy, and we welcome Daniel Knapp on stage.
Hello. You're far too kind, thank you very much. But I will speak fast and have 25 minutes and I think over 40 slides, so please buckle up. A drama in 4 acts, state of the digital ad market today, globally and in Europe, and what the read-through is on programmatic. We're going to start with the kind of macroeconomic picture, which is quite confused, and which lies the foundation for many of advertisers' investment decisions. We're then going to switch to the advertiser side and say what's new, how are they re-architecting their thinking in this uncertain world. We switch to the media owner side, what channels are performing, what's happening with publishers, what's happening with retail media, what new exciting alliances are we seeing, and then we're going to see how is programmatic changing and wiring this all up. But despite the kind praise I've gotten, I think I must actually do the opposite. It's a terrible idea to have an economist speak about the future. I mean, we make astrology look respectable. Economists are notoriously bad at forecasting. So please take everything I say with a grain of salt. Think of it more as a vectors of opportunity rather than the actual, digits behind the numbers. But I think the fog is lifting on the future, and we can see some really exciting contours emerging, which is going to structure the future of our industry. But first, there is still fog. Welcome to Schrödinger's economy. It's a bit like Schrödinger's cat, right? It's dead and alive at the same time. We only know if we look. We cannot hypothesize when we just look at the box. Why is that? There's a fundamental disagreement among governments, economists, of course, and many others on the future trajectory of the economy. And the forecasting quality, what the market is going to do, is actually going down. And I stumbled across this fascinating chart which really shows at what a loss macroeconomic experts are. You can see behind me the gray line, which shows the forecast consensus range. When economists at the beginning of the year say, how much is global GDP going to grow, right? You can see, of course, there's some divergence, but as the year progresses, that gray band narrows and they come to a consensus. Now look at this green line here. We can see massive outliers, meaning high disagreement between economists what's going to happen. Is the economy going to grow or not? Are tariffs really going to come? Is it going to be 100% on China or not? We don't know. And I think this fundamentally predicts every market participant's, consumers, companies, policymakers' ability to take the right steps and decisions. And this has become so severe now that, by the way, this is a chart from an economic paper. No economist I've seen can put a high-resolution chart in a paper. But I had to take this one because it shows something fundamental. We can usually see, we see 2 lines here. One is the VIX index, which is a measure of stock market volatility. And the other is, and I showed the chart on this last year, the global policy uncertainty index, which is there heightened uncertainty in the political environment? And we can see this policy uncertainty index is exploding to record highs. But stock markets are chugging along. The volatility isn't there. You could say, is it a breakdown of correlation? But no, as it says behind me, it's the opposite. The uncertainty is so high that many have given up of pricing it in the first place, right? And this is a perfect example of the Schrödinger's economy. High uncertainty, but high investment at the very same time. What follows from many of these things is that the sources behind this are not purely economic in nature, but they're more geopolitical. We have, it doesn't surprise anybody, in recent years seen a fundamental reversal of how the world operates. It used to be in the post-Second World War order that economics determined policy. Now it's the other way around. Politics, and increasingly in a fragmented, not anymore globalized world, but fragmented world into blocks, is determining the economy. And that changes affect supply chains, how every company prices, etc. It's outside of our industry, but given advertising is such an engine for growth for companies. These things are crucial to bear in mind. The last thing, I think, that determines the Schrodinger's economy is something called K-shaped events, right? It's in the letter. Something that at the same time is positive, goes up, and goes down at the same time. And I think the debate on AI and how it contributes to economic growth is a perfect example of that. On the left hand here, you can see the surge in business investment in what's in the US called information processing equipment. Basically, that's AI, data centers, IT infrastructure, etc., on a record high, massive surge. But then when you look at GDP growth, we can see that if we remove any AI investment from US GDP, growth was anemic at below 1%. So we have a situation where AI investments contribute overall 4% to the economy, the volume of the economy, but over 90% of economic growth. So if we remove that, there's hardly any growth. What does that mean? Hard again to forecast. Is it going to mean more productivity? How is it going to affect labor markets, etc.? And all these things kind of cause a forecasting paralysis. These things combined make it, second act, incredibly hard for advertisers to decide how much budget am I going to put where, and how can I get out of it again if the lower part of the K comes into the foreground. What we see is what I call a financialization of marketing. It's in the name, right? More and more financial decision makers are determining how much and where marketing spend is being allocated. Last year, I showed you the roller coaster of digital ad spend, where I looked at quarterly growth over time. And you can see again behind me, you can see this roller coaster, the ups and downs since COVID. We had in 2024 a little bit of a breather, which you can see this here in the darker colored slots, where it seemed that this quarterly up and down, this volatility had finally come to an end, and the roller coaster was on the finish line. Advertising seemed to be chugging along normally again. But of course, we knew that this couldn't be sustained now with the global uncertainty so incredibly high and the K-shaped events in Schrodinger's economy. We are back at hyper volatility. In this world, advertisers have said, right, we need to change how we think of advertising and how we organize it within our companies. An example from Germany, which I think is seismic regardless, is essential. Mercedes-Benz said, we're going to ditch the role of the CMO, not because marketing isn't important, no, because we need to connect marketing to sales. So the former CFO had a new title, CFMO, Financial and Marketing. So now it's spreadsheets and accounting that determine where marketing goes. And this is, of course, tied into broader business transformation initiatives these companies have to do. Then to see how can I create efficiencies with AI, how can I enhance digital consumer workflows, etc. And advertising, in a sense, becomes a component, a function of this overall digital rebuilding of the company, which is governed by financial imperatives. If we look at what marketers are talking about, these financialized marketers and everybody on their earnings calls, we can see something quite remarkable. The chart behind me, let me contextualize it. What we did, of course, in the age of AI, we looked at the earnings call transcripts of 500 marketers globally, the largest listed marketers in the world, and said, when they speak to their investors, to the equity analysts, what are they talking about when it comes to marketing? And this chart here looks at what percentage of, in a sense, airtime, what percentage of sentences or semantic units that they talk about, the CEO, the CFO, etc. How much of that is dedicated to marketing? It's quite a lot. We can see marketing has become, this has increased over time, an essential communication strategy to public markets. Of course, you can see some things like consumer staples, communication services, consumer discretionary, so the large kind of CPG, FMCG advertisers, they spend a lot on marketing, usually over 20% as a share of revenue, and they speak about it most. And you can see it, I think, right behind me here. The ad intensity, as we call it, is the highest. We have a new breed come in particular in Europe, where digital endemics are coming in, be it last mile delivery companies, be it direct-to-consumer companies that are also investing heavily in marketing to acquire new customers. But we can typically see a correlation between airtime that marketing has and, of course, the volume of overall investment or ad intensity that there is. Now we need to contextualize things. How do marketers speak about marketing? Mostly, they connect it to revenue growth. So here we looked at, when they talk about marketing investment, how are they justifying increases? behind me, you can see all the things that are boxed in relate to, in a sense, a very traditional way of allocating it. If the revenue grows, marketing grows. Those who have more niche markets, like share of costs, share of COGS or share of installs, etc., they're usually in more niche and performance industries. This is a statement, but it sets, I think, the foundation for a foundational diagnosis. And this is evident in this chart. What I have shown here, since the last financial crisis, Lehman crisis, 08, 09, 4 consumer packaged good advertisers, right? Those who talk most about marketing and those who have the highest ad intensity. What happened to their share price and what happened to their revenue over time? We saw massive share price increases, fueled by, of course, overall market acceleration, but also predominantly financial rigor, cost savings. But the revenue line has been anemic. 1.1% growth on average per year. So there's a huge gap between the valuation of the companies and the revenue growth. Companies are not growing anymore, and they realize, why? We're advertising. Is advertising not working anymore? Why is advertising maybe only helping with the share price, but not with revenue growth? This isn't sustainable. And we can see this when we took a more kind of longitudinal perspective and look at revenue growth for companies on a quarterly basis over time. You can see that dip coming here at the end of 2024. This dip in revenue growth comes coincidentally at the same time where ad intensity for these companies is on a record high. Many companies that are experiencing record slow growth are now investing as a proportion of revenue more in advertising than ever. So there is some kind of glass ceiling coming if the marketing engine isn't changing. If it is not really helping to drive brands and also to drive real growth bottom or top line for the companies. Good news is, globally for all of us here in the room, that despite this coming glass ceiling, most companies want to continue to invest in marketing. So around 60% of all these 500 are saying, we are going to increase our investments in 2025 because we see marketing is so vital. But if you look at the quotes behind me, you can see quite a few of them are again saying we're at record or near record highs. So what is good news for us as an industry, more investment, is also bad news, because if we as an industry do not change what advertising delivers, this relationship between revenue growth and advertising growth might break down. So we need to reform what we do. To put some context to this, here are 8 companies, CPG and also beauty companies, and you can see 5 key priorities that they're actually doubling down on in order to break this stalemate, if you will. You can see data, targeting, crucial, branding in digital channels, but also AI is coming more and more to the foreground. It's difficult to discern in these investor calls what really is just lip service and painting this bright, buzzwordy future and what are real heavy initiatives. But more and more we see more specific statements on AI, not just the name dropping, but clear evidence of initiatives that have been taken and the impact that they have generated, as you can see, for instance, in the Estée Lauder and in the Coty examples. I think they illustrate this quite well. All of this is connected by outcomes, top and bottom line business growth. And when we look at the rise of key terms that marketers mention in their earnings calls, AI, creative, and outcomes, they all feature the strongest. So these are the themes that we as a programmatic industry need to double down on. How can we cater to those needs? Because ultimately, this quest for outcomes, if we map the roller coaster again, it actually maps beautifully over the recent growth that we have seen. The stabilization of advertising growth and the re-acceleration of advertising growth correlates with a massive rise in outcome-related terms and initiatives that marketers are doing. Outcomes for some mean performance. For me, it means something more. It can be brand advertising as well, because it's about growth and not just about media metrics. But there's a problem. For some, it has meant moving to highly measurable bottom-of-the-funnel channels to a rampant short-termism, which is a mistake, I think, because if we look at a survey, what equity analysts, the ones who marketers want to wow on those calls, what they actually value in saying buy, sell, or hold the stock, look at this. It's our industry. How strong the branding and the marketing is matters fundamentally to how share price evaluations are being conducted. Some are saying, all right, just go back to broad reach, Byron Sharp style branding, nothing else. I also think that is misguided because the fabric of the consumer has fundamentally changed. If you look behind me here, we can see consumer choice and consumer touch points, and the diversity of products that consumers purchase and interact with has completely changed in the last decades. Left, we can see how many SKUs are actually available on average in supermarkets. 1975 to 2008, massive explosion of choice. We can see also the number of manufacturers in supermarkets has increased. The type of product that people buy the brands on Amazon, as an example, for e-com, has exploded. Not every toothpaste can have a Cannes Line winning ad. So it cannot just be about branding, it needs to be about other things as well that drive outcomes. To do all this, we as an industry are coming together and hopefully reassembling to drive this. The good news first, advertising is growing. We are about to become a $1 trillion industry globally, and that's just sell-side revenue. So everything arriving at the publisher, media owner, platform level, not the production fees, not what agencies do, not the cottage industries around IT transformation, etc., just what's arriving at the sell side. In Europe, the market looks as follows. This is a picture from our latest ad spend study that we conduct in IAB Europe, where we look at the size and the dynamics of the different advertising markets. On the x-axis, you can see, in a sense, how mature the market is by ad spend per capita, adjusted for the purchasing power in a given country. On the y-axis, the dynamism of the market, and the size of the bubble is the size of the market. Of course, in the Nordics here, we are in a digital-first society. We were very early when it came to digital. So growth is a bit lower, of course, than in the kind of next mover markets that we can see, in particular, emerging in Eastern Europe. But growth is still fairly strong. Given the state of maturity that the industry has. That also means, of course, a certain degree of professionalism, which can set the foundation for the next phase of growth, be it in programmatic or be it in AI, that some of the smaller markets here on the left side of this chart have more struggle unlocking. But this spend isn't going to go to every channel in the same way. I tried to outline this here by looking at various industry sources to document the divergence in media spend allocation, partly by company and also by channel. Clear winners which haven't changed since last year, retail media, CTV exploding, digital out of home, etc. Now when we look at so-called content media, so every media company, traditional or digital advertising that monetizes through the production or distribution of editorial content, they are, in a sense, not growing. There is, of course, a move from traditional to digital. Digital is growing in many cases and some not so much, but there's an issue here. There's another issue also that some are saying if the open web is not reforming, it's actually going to lose share to some of those other walled gardens who are perfect. I mean that as a real compliment at driving those advertiser outcomes, or at least perceived outcomes. So removing friction in the buying process, finding metrics that make the CFO happy, is essential for the open web and therefore for programmatic to continue to thrive. We've struggled with fragmentation to do this, so we need to aggregate, create interoperability and new partnerships to make that happen and also move beyond media decisions. Interestingly, although marketers are saying content media, if it's not changing, we can't put too much effort on it, they're looking now at other types of content media. Behind me, you can see the global media industry or professional media industry, right? From studios to advertising to subscriptions, and the creator economy. And the creator economy has a massive growth. And we can see that some advertisers are saying, okay, we need to change how we do brands. We need to move away from one-on-one targeting to, in a sense, address communities, micro-communities, work with those to create compelling content, and they increasingly see creators as media brands. So Unilever, for instance, is really doubling down on this, and that often comes to the detriment of other channels, such as the open web. The good news is, for us, that in Europe things are different than in the US. We shouldn't always look at the US or equate US trends with things that are happening in Europe. If we look at content media, the market size evolution over time, we can see that the US have really struggled. Content media have massively eroded. In Europe, the erosion was half of that. Yes, it's going down, but it's partly, of course, a shift from traditional to digital media. So we have strong and resilient media brands in Europe that far more than in the US can withstand the structural challenges, consumer challenges than we see elsewhere. So this is really something to cherish and to double down on and to protect. Of course, what has emerged recently is the world of retail media. It's now a huge market. We initially thought it was going to be a 31 billion market by 2028. We have, at Demexco in Cologne earlier this year, downgraded our forecasts. You can see the new and the old forecasts next to each other. And the revised outlook really goes back to a concern of, is the gold rush over? I don't think it's over, but the easy money part is over. Now it gets harder. Retail media has a couple of challenges that it must overcome. First, there are weaker macro signals. Consumer discretionary expenditure growth is lower. That affects, of course, anything in e-commerce or commerce overall. E-com penetration, which was fueling particular digital retail media, is stagnating. The store still remains hugely important. Over 80% of purchases are being done in store. We can still see a strong reliance on trade marketing budgets, so not really digital advertising budgets. Advertisers are restructuring, but there's a long process of getting those budgets, which are not measurable at all, into a media mindset. And that's something that we as an industry have to be stronger at accelerating. Brands also think that without good data, retail media becomes more of a tax than an investment. So retailers really need to open up their data capabilities and show more to brands. And lastly, there are demand constraints. This is where programmatic comes in. Over time, retail media will need to open up to new demand, to other advertisers that the sales teams of the retailers don't interact with, and also to non-endemic demand, i.e., let's say, for instance, a travel company advertising in a supermarket, although the product isn't on the shelf. We're now seeing a rewiring of that world, and it's kind of like 2008, 2009 in the publisher world, where suddenly programmatic becomes really interesting. Markets are moving. We can see that the first mover markets are not growing as fast anymore, but second mover markets and the Nordics in this as well are actually growing quite strongly. We can see retail media is also evolving across channels. We are in a 1.0, slightly 2.0 world, but we can see what's being measured, what channels are being activated in store as well, etc., is still underpenetrated. So that's something that we're going to double down on. And good news for us as an industry, the vast majority of growth in the future from a small basis will come from off-site media. So not selling sponsored product ads on page, but search, social, but also programmatic, finding consumers elsewhere, often higher up in the funnel. So the rise of retail media and the rise of programmatic are slightly becoming intertwined. To do this, retailers really need to change their approach. They're often still in that low quadrant over there, performance media channels. They need to move up to become strategic media partners, measurement standards, more open communication, data sharing, and only when they do that can they become strategic growth drivers for the business outcomes. The last and final stage, and few can unlock this right now, is to become, in a sense, some kind of ecosystem hub where you say, if you're a beauty retailer, I am the single source of understanding how beauty customers tick. I know them, I know how they evolve, I can anticipate that, I give you those insights, and also I give you the activation strategy to unlock that potential. Programmatic is going to be crucial here, and we can see, for instance, how high programmatic penetration is on the web, out of home, and how low it currently is in the both digital and in physical retail media. So that's going to be a new growth era. To thrive, programmatic needs to become more of an assemblage and bundle things together. If we look at those 5 things, content, media, ads, audience, and commerce, this is the old model that we know. I think we, and sometimes often also in the trade associations, are still too stuck in this current model here and not really building products and services for this future model, where suddenly content becomes algorithmic in production and distribution, where media are ubiquitous, where creators, publishers, retailers, and others are forging new alliances to create scale in the open web. Audiences are bespoke, not necessarily one-on-one, but bespoke, and also media themselves become shoppable. Lastly, and we're precariously running out of time, I want to touch a few seconds on the programmatic infrastructure that makes this available. We've seen, after a slowdown, also concern around third-party cookie deprecation, a re-acceleration of programmatic spend in Europe in 2014, and we're expecting a similar growth rate for 2025. But within that world, under the hood, it's a fist fight. right? We're seeing a fight for margin, for control and differentiation between DSPs and SSPs. Think of the recent transaction ID battles, right? Pre-bid versus others, transparency, and also the thing about who controls the decisioning, right? We have the signal businesses on one side that provide data signals. We have media execution businesses on the other, and they realize one without the other is somehow commoditized or not adding value. So it's all about controlling decisioning, and companies are moving in that space. But not everybody can win. Either you are highly scaled or you have a unique differentiation to do so. And here was a great slide that I saw recently, which I adopted. In a sense, we look at the journey of programmatic from before the first ad exchange was launched over header bidding, right? Everything in JavaScript, to the unified auction and the pros and cons of moving control back to the ad server in a black box. Now to this era of kind of competition, who owns the customer, who owns the auction, to a future model. And if you look at some announcements recently, like the ads context protocol, which is about agents negotiating, in a sense, direct deals, we're in a sense moving back to the world of the ad network or the work of humans and fax machines, just with AI. So many things open how the world is going to evolve. AI is going to change a lot of things. We know it. I'm not going to touch too deeply on it, but we just see, when we look at some of the company statements, Alphabet and Meta, there is this FOMO, right? Saying we need to invest regardless of what the outcome is going to be because we can't afford to miss the next platform. These things are changing dramatically. We can see the AI explosion changes the economics of the web. Overall, AI search is still low, but if we look at the early adopters and extrapolate this, probably around 50% of early adopters, 50% of all searches from early adopters are already on AI. We think if AI companies start to monetize, look at ChatGPT, for instance, we did some calculations compared to Google, how well is their monetization intensity. You can see if they launched ads right now, it would be around between 1.5 to 2 billion, very low, but we can see new players moving in this market. And then to conclude, if we see ad tech as cycles of consolidation and fragmentation, investment upturns and downturns, we're entering the next phase. We're going to be structured by AI and by privacy, which is affecting also agencies and others, because we can see that while some agencies are suffering, those who are doing systems integrations on this future operating model and IT model for advertisers are thriving and getting lots of contracts. I think in this world, several new agency models emerge, where agencies either use AI to optimize, drive efficiencies, where they start to do outcome-based pricing, where they tell tools and services, or whether they start selling their data and their intelligence, in a sense, to feed to advertisers. Companies overall have three choices. Either be kind of a landowner where you own the data, you own the algorithms in a kind of a walled garden, a farmer where you work on someone else's stack, someone else's data, someone else's intelligence, and you don't own the decisioning, or, which I think should be the future for the open web, you're a landscape architect, where you combine different things, bring them together, orchestrate them, and build this new ecosystem. And if we do that, if we become good landscape architects and programmatic, I think then we can unlock this promise of outcomes, and we can stand here like this, in this New Yorker cartoon, the old patriarch overlooking the Manhattan urban jungle and saying to the young apprentice, somewhere out there is the key to increase sales. Let's find that key. And I think that's the mission that we have in our industry. Thank you very much.
Thank you very much, Daniel. And I want to just ask you one question. I'm not going to ask you a lot because you're going to join Daniel in a fire chat in a few minutes. And he's not easy to control, but if you could, if you had that magic wand, what question would you want him to ask you?
Really about publishers.
Listen now.
Why are publishers still seeing themselves as adversaries and not banding together to create a larger front in the open web?
Okay, good.
Noted.
Yes.
Thank you.
Thank you.